Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Thank you, Jim.
S&P continued Canada's AAA credit rating. Is that important?
Well, it's better than downgrading it, I guess, but really at this point, it's kind of an esoteric point. The world is in a race to see who can add more debt, and that's sort of a relative change thing because everyone's doing it at the same time. And so, so far it's good that the rating agency thinks that Canada will be able to make its commitments. But, there's a lot of change happening in a very short period of time here on all these ratios. And, the really big excitement lately is that, there's the presumption is almost as if the pandemic never happened, as if things are so great that, we're going to be back to the good old days anytime soon. But the reality is, of course, that the good old days were slow growth because we had an aging demographic problem, because we had low birth rates, because we had overvalued asset prices left and right, and because we had record amounts of debt. And the amount of debts that were on the books before the pandemic hit were sufficient to slow our economic growth trajectory, to keep inflation under 2% for more than the last decade, no matter what the feds have tried to do to increase inflation, because that's always their goal, to try and get some target of 2% hit. They failed to hit it for the decade before, and of course have failed in the last year thanks to all the collapse in global demand after the spring of 2020. So now we've got a future where we've added trillions worldwide, and people are, the asset markets are pricing in jubilance at the prospects of returning to this new normal that's going to be even slower than we were in 2019. So it's really, it doesn't compute here, right? The things don't add up. And that's, I think, the basic problem. So although, maybe they haven't downgraded our debt ratio or exposure or rating at this point, the numbers have changed profusely on the debt side, and the growth side is only, barely better than it was, a year ago, and worse than it was, in 2019. So, even when you look at what happened, the U.S. GDP print that came out of just over 6% in the first quarter, the thing is that with all of the trillions of dollars that have been spent, like the U.S. itself has added something like $12 trillion of stimulus with the T in the past year between the fiscal and the monetary efforts. So, holy cow, we only got 6% growth out of that is really what the reaction should be, rather than amazement that we did. If you back that out, David Rosenberg's done some really granular work on this. If you back out the amount of funds that have been injected, the first quarter U.S. nominal GDP would actually have been negative. So we've got, the multiplier effect at the very best here in terms of the amount of dollars that are being printed and added in terms of trying to stimulate growth. You're getting pennies on the dollar. We were getting pennies on the dollar again before the pandemic, and it's only worse now. Hoisington Management estimates that the U.S. government is getting something like 0.38 cents of multiplier for each dollar spent here because they're so heavily in the hawk in the process. So it's really a very interesting fantastical time in many ways, and then at the same time, as I say, asset markets acting as if the pandemic never happened. Meanwhile, we're nowhere close to through it, right, Jim? The reality is that we have, probably a couple more years before we have any hope of inoculating 70% of the world population, a level which is thought necessary to stop this, the spread of COVID and to get it back under control. And right now we've got new variants that are, spiking the incidence of new infection in places like India to over 380,000 a day, yesterday, record levels. This is the sixth largest economy in the world, second most populous country in the world, behind China's 1.4 billion. India has 1.3, and we're having this massive outbreak in a country that thought they had some kind of a inherent antibody or some magical solution to coronavirus, right? Because in the last even though they have that big population density, last year, they had still relatively low levels of infection. And so there was a bunch of people saying, India is somehow different and they have access to supplies of vaccine because they produce it for global export. So everyone was thinking India is somehow getting away with something. And of course, now we see this explosion of infection in that country. And then you've got other places like, Brazil, where certain parts of the country, had a big fall off in the rate of infection, after some 60% of the population had tested positive. So the thinking was that, parts of Brazil had been so infected by coronavirus that, in fact, they were now showing herd immunity effects, and that was great. But in January of this year, we saw another massive resurgence in cases there because this new Brazilian variant has apparently is not impervious to the antibodies that were acquired from the previous strains. So there's a lot of questions here about how long it's going to take us, to get the world back on its feet, so to speak. And no matter what that reopening looks like at this point, the asset markets in the world have priced that times 5, if you get my point. So no amount of upside surprise here seems likely to justify the valuations that have been acquired through all the stimulus funds that have flowed into asset markets in the last year. The amount of money that's been lent to sketchy companies, we've talked about this before, where you've got record amounts of junk debt now trading in the world at the lowest yields ever in history. So in other words, there's so much cash flushing around the system and is desperate for somewhere to be. So you've got this whole bunch of allocators that are funneling it into anything at all with no concern about whether it's investment grade or not, just trying to do something with it. And that's really a recipe for complete disaster.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, can the stock markets keep setting record highs? It seems there's a new one every day.
Yeah, there is. And sure, why not? There's no connection here between the price of these assets and as I say, any kind of expectation of growth or of profits or of sustainability. It's really just completely untethered. So when you're dealing with complete financial mania, this is like a tulip mania of the 1600s. You can have ridiculous price moves, but the more important part, I think, is that it's never a never-ending thing, right? So the higher it goes, the crazier it is, the less tethered it is to economic reality or financial reality for people on the ground. the more likely that you're going to see a massive implosion. And so it really just sets up the downside that much further with each passing month that this goes on. I think that, the thing is, any correction in the equity market at this point, any correction in the housing market, which has also been on fire, not just in Canada, but in America in particular, any correction there is going to wipe out, this euphoric sentiment, because it isn't based, as I say, on economic recovery or growth prospects. I mean, the U.S. Unemployment rate in April is something like 6%. It's nearly twice as high as it was in 2019, and similarly in Canada, 7.5% or so unemployment rate in Canada. That's still well above where it was in 2019 at about 5.6. So and all of the gains that have happened in the housing prices have nothing to do with gains in wages, right? If you look at a chart of hourly earnings or, household incomes relative to shelter costs, the shelter cost line is like parabolic and the income line is flat at best, and that's with all this government support. So there is no rational connection between what we've seen in terms of affordability, and there's no, as I say, that the economic prospects, whatever people think they're doing in asset markets in terms of the stock market or corporate debt market, whatever they think's going on there, it's not investing. It's some kind of speculative mania. It's just cash looking for anywhere at all to be. And so, now what's happened is the Canadian economy, for example, has become so dependent on the housing market that it defies any sort of stability. Sort of like more than 9.3% of GDP is now dependent on housing as a sector. That's more than double the long-term norm for that statistic. And in the process of all this mania, of course, we've seen this big run-up in commodity speculation and stockpiling, and prices have gone to the moon. Things like lumber, has nearly tripled. And so at the edges of this, there's always some logic or story, and the story is this insatiable housing demand, which is fueled also by governments, by central banks getting interest rates to all-time lows, by governments backing the mortgage market, which they do in both North America and in Canada and America. So without that support, there wouldn't be this kind of frenzied ability to consume credit and housing at all-time highs. But so that stimulus, along with the income support, along with the deferral of payments, all these things have really just allowed this kind of, like I said, almost like a fairy tale land of financial inputs. And so we know that inflation is a lagging indicator. So this run-up in commodities, it could go on for a little bit longer, and while it does, the Canadian dollar, is on a tear. The equity market is on a tear. Again, this inflationista kind of thesis. But if inflation is a lagging indicator, and if, the bulk of the stimulus has already been pushed in, and we've kind of got so far above any kind of reasonable level here on all these metrics, that it could very well be that we're start to see a disappointing measure coming now when people look at, perhaps a downturn in the growth metrics that we've seen. So GDP, for example, can't go up 6% every year. It's done so on this Herculean support. So if we see that the growth starts to moderate, which we think it's going to do by the third quarter, heading into just out of the summer. We think the data is going to start to come in a lot cooler. So does the Bank of Canada, by the way, which is forecasting that in 2022 they're going to see a drop in the growth rate back into the low twos in terms of GDP. So about half the rate it's been clocking in 2021. So again, as I say, we're battling here against a pandemic which is not yet over. And we're supposed to be jubilant, according to the asset markets, about getting back to a slower growth normal than we had in 2019, with even more people out of work, more people indebted. So it's a dangerous time, I think, because people can get caught up in the mania of what's going on in, as I say, housing or in speculation in financial markets, and they're doing self-destructive things. So, I was putting on the blog, there's a lot of articles lately about, people, for example, with student loans who have, the student loans have been payments on deferral during this period, and the Fed's dropped the interest rate to 0% on student debt while this pandemic is going on. And so instead of using the opportunity of really low rates to get out of debt sooner, which is a really great thing to do with really low rates, use them to your advantage by, reducing your debt faster than you would have been able to do at higher rates. Unfortunately, what people are doing is they're taking the funds and doing things like putting it into the stock market because they're saying, maybe I can grow my way out of poverty, or maybe I can grow enough to buy for a down payment on a hopelessly expensive home if I take some, gambling here with this money instead of paying down my debt. So this is essentially levered investing is what you're doing, because you have debt that you're not paying off and instead you're putting it into financial speculation. And they think that they're doing something intelligent because they rationalize, well, interest rates are nil on this money or nearly nil on this money, and all I have to do is make, X. So I just suggest to them, it's like, well, why don't you just buy lottery tickets at the same time? I mean, it's essentially as good an investment idea to buy lottery tickets as it is to put funds into random stock market picks or into even funds of stock market picks at these levels. Because what's going to happen is even though it may look like you're winning for a little while, when you get a mean reversion in price, you're still going to have that debt. You're not going to be any further ahead in terms of your income or earning potential, and now you're going to have lost any principal that you put in. So it's a very destructive incentive, and that's what the policies have really encouraged people to do. The bidding wars on the housing side, making bids on homes they haven't even seen or they haven't had the opportunity to have any inspection on, or that's 30 or 40 or 50% above the asking price. Like, this is just lunacy. It's got nothing to do with what's in the best interest of the person actually involved in this, and it's everything to do about, who's getting commissions off the transactions.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, continued ultra-low interest rates, good or bad?
Bad at this point. Bad because they are incenting all this speculative fervor and self-destructive behavior, as I was just describing. Bad because they are eroding the ability of retirees to fund their retirement. Funds that people had squirreled away thinking it was going to be ample to fund income needs during the later parts of their life. They're finding that they have inadequate capital stores, and or they are reaching for very dangerous assets in order to try and generate a higher rate of return. We see this with 70% of fund managers now in the world are, buying into this hope that things can keep going up, even though all the euphoria, panic measures, and sentiment indicators that we follow are at such extremes that 100% of the time stocks have been lower 12 months later. And they're trying to sell people on this idea that we're into this new secular upturn, that from now on stocks are going to continue to be, priced at all-time highs and continue to go from here as if we're in a new secular upturn, where none of the data or metrics or valuation measurements suggest that that's likely from here. No cycle has ever begun from the highest valuation since 1929. 1929 and 2000 are the only other periods that we have to even remotely compare to the craziness that's going on right now. So, what's really happening is people are reaching for yield. Funds have fully invested, chasing fear of missing out, fear of underperforming for asset managers. Monies that they used to be able to put in, for example, government bonds and earn 5%, or even cash deposits and earn a couple of percent while the funds were there. They're now earning next to nothing on cash. They're earning, less than 2% on the government bonds. And so rather than, just deal with that reality, plan to withdraw less, figure out ways to make the funds last, they're reaching for higher risk stuff. This is a complete disaster. For anybody that's sort of a decade away from retirement or already in retirement, this is exactly the wrong thing to be doing. And yet that's what the general incentives now are in the system. So it's a very bad thing. It's as I say, it's only good for debtors if interest rates are low, and only if they use it to get out of debt faster. But if they use it to go further into debt, which is exactly what Canadians have done in the last few years, then that's not going to help, because when rates eventually do have to trend higher, that's going to quash the ability to consume and spend even more. So we just keep pulling from the future consumption ability and spending it in the present, and we've done that in the last year, to a factor of about 10. So it's really just digging a deeper hole for us to have to fill before we get into sustainable growth after that.
Also, low interest rates, isn't that one of the factors behind skyrocketing insurance premiums? Some condo buildings can't even get insurance now.
Well, insurance is priced off of the actuarial calculations that they do around risk and what sort of loss they're facing for a particular type of coverage. And it's also to do with, rates of return in asset markets. And typically, insurance companies need to match their liabilities, their expected payouts, with things that come due in those years. So not, tech stocks, we're supposed to be matching with things that actually have a maturity date, have a guaranteed return of principal function. Those are things like government bonds. And if those are paying, less than 2%, well, clearly the insurance company has to make up that difference, that lost yield, some way or another. And so obviously pricing of products is something that is one of the obvious places to increase the cost or the price of the insurance to cover that.
Danielle, before we go, we have a listener question. And the question comes from Justin in Berkeley. He loves to send questions, by the way, to Bob Hoy. He's a frequent listener and questioner. We have no problem with that. His email to us: I appreciate Danielle's approach to investing and would love to know her opinion. Most people are starting to get flop sweat with the ever-increasing prices of equities and other assets like home prices. Everyone is shocked when I say, honestly, hate the stock market and would rather have some dry powder around just in case. Is this okay to hate the markets? I don't see any value out there. Does she have high inflation expectations?
So I think we answered some of this in the previous discussion, but I would have to say, first of all, that I don't think it's helpful to hate or love these things. Asset markets are what they are. They're supposed to be based on financial and return prospects, and they're supposed to be priced accordingly. They aren't right now, as I was mentioning. So I don't think it's okay. I think it's fine to be indifferent to them, to feel like you don't need to participate in them. In fact, I would recommend that to people rather than get pulled into the slippery slope of, trying to race to catch up or feeling like you have to be so risk exposed, you have no other alternative. I would recommend that you do have an alternative. It's called price discipline and self-control, and there's no need to, just jump into harm's way because the masses seem to be doing that. So it's certainly fine. I also think it's a potential slippery slope to mental anguish, even when people are buying, trying to pick stocks in this environment because they see things, jumping so much in a given day and they think they're missing out on something. Many people find that even if they do, take a portion of their money and say, fine, I'm going to use this as a gambling fund and see how I do, that it can become this very dangerous mental a predicament where you're elated on a given moment or afternoon or morning if something, jumps in price, but you're devastated if it falls. And this kind of a following of things on a daily basis and day trading is really the antithesis of peace or happiness, and it can really erode your what you're supposed to be doing in terms of your attention, and it's not that constructive. So I think it's actually more than fine to say you don't want to be involved in a casino and a gambling environment, and that you'd rather, be more conservative and realistic with the way that you manage your finances. And in terms of do I have high expectations for inflation, I think we touched on that as well, but basically inflation's a lagging indicator. It has rebounded very significantly from the lows of the spring of 2020 when everything fell off a cliff. But ultimately, I don't think it's going to be sustainable past, another couple of quarters perhaps. I think there's a lot of financial speculation that have gone into driving up the price of commodities, and that's a self-fulfilling expectation in terms of people thinking, inflation is now taking off like crazy. So it's more likely that you're going to see a moderation in growth and inflation as the weight of debt takes hold, as the reality is that people have already spent a ton during this recession. The pent-up demand side here on the goods side is much weaker, certainly, than it has been coming out of past recessions. And typically, the other thing about inflation is that in past recessions, it's taken an average of just under 4 years to see the bottom in bond yields, and about an average of about 7 years to see the bottom in inflation. So it tends to be spiky at the start, coming out of the depths of a recession, peak, and then roll over again. And that's what I think is likely to happen this time as well.
Danielle, thank you so much for being on the show.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.